And while we're waiting for everyone to jump in, I'm going to kick it off, I guess, with a quick introduction. If this is your first webinar that you're joining or not quite familiar with GBS Retire, who we are, I'll do a quick introduction as well as myself, Rocky, on the team. GBS Retire, we are the retirement arm of GBS Benefits, part of the Levitt Group as well. So regardless of if you're coming from one of our retirement plans that we're helping manage from GBS Benefit, employer, or the Levitt Group, or you just saw us on LinkedIn and decided to pop in, welcome to our webinar today. We'll go through a few different topics today around your total financial picture. I'm really excited for this webinar. The last couple webinars we did were a bit more specific around pre-tax and Roth. We did an employer stock webinar last time as well. So with this one, I want to take a little bit of a step back, cover a little bit more broad topics around your total financial picture and talk about just beyond retirement accounts. A lot of what we do gets sucked up in just retirement planning, retirement. So I want to take a step back and cover your whole financial picture and some topics there. We are recording this, so the presentation will be sent out. The recording will be sent out tomorrow in a link. So everyone who's registered, you'll get that recording tomorrow. And then if you have any questions, I'll make sure you have our contact information as a way to follow up with us with any questions that we don't cover today. As we go through the presentation, feel free to drop those questions in the Q&A. We'll try and get those to you, get those answered as we go. And if not, we'll save some time at the end for questions as well. Just a background on myself, Rocky on the team. I am the certified financial planner at GBS Retire. So a lot of what I do is individual meetings, group presentations, as well as these webinars. These webinars are great because it allows us to cover high level, a lot of different topics with a lot of different people. But where I found where the rubber meets the road is in those individual consultations. I'll have a QR code where you can sign up for just a free consultation to review your financial picture, where you can cover any of the topics that we go over today, more specifically to your situation. So we'll cover a few different things today around your total financial picture, but I wanted this to be just beyond retirement accounts, right? Because we get enough rated at us day in and day out about saving for retirement. Retirement's important, yes, but it's not the whole story, right? We have to take a look at our financial foundation to make sure that when we make those moves for the future, for retirement, we know those can be in place and not be subject to unexpected instances going forward. Before I dive in, one example that I like to give, and I'll probably refer back to it throughout this presentation, is a gentleman that I was working with. He came from one of our retirement plans that we were managing, and he came to me and we were talking about his situation. He was trying to pull money from his 401k, and he was stressed out. He felt defeated because every time he contributed to his 401k, he ended up having to take a hardship, cash that money out to cover an emergency. And he just felt defeated and he didn't see any point in continuing to contribute to his retirement account. And I said, well, hang on, let's take a step back. Let's look down deeper to see where the actual issue is. Because the issue is not contributing to your retirement account, saving to your retirement account. There's got to be an underlying issue deeper. And so we looked down and found out the issue, it wasn't his retirement savings, it was his budgeting and his emergency fund. He didn't have that in place. And so when an unexpected emergency, I use air quotes there because while emergencies are unexpected as to when they're going to happen, we can expect emergencies to happen at some point, right? They're going to happen and we can prepare for them ahead of time. But he had those emergencies come up and he had nothing to pull from. He already had some credit card debt, so we didn't want to go any further into that. And so we'd be pulling from his retirement accounts. I've seen it many times where if someone does not have the financial foundation set, saving for retirement doesn't do a whole lot of good. So let's dive into some of the things that we go through today and a few different topics that I want to touch on today. I had a note about sound, so let me make sure my microphone, let me switch that and see if that's better. All right, hopefully that's better on the sound there, so we don't get quite as much of an echo. Let me know if that is still an issue. But we'll cover a few different things today, mainly around your whole financial picture. I want to touch on some trade-offs because that is a big decision and thing that we have to realize. There's always going to be trade-offs between our priorities that we're making within our financial plan, as well as some areas that are often overlooked, and risk management. I'm not going to cover on them in this order. I'm going to bounce around a little bit today, but feel free to drop any questions in the Q&A, like I said, as we go. And then lastly, before we jump off, there is a tool that I want to share, make sure everyone is aware of, to actually give you some actionable items that you can use to help implement some of the things that hopefully you'll learn today. I want to make sure that we provide some good value, but also something you can take away from this as well. Retirement is just one piece of the puzzle. Like I mentioned, there's a lot of different things when it comes to our financial planning. When we look at the CFP board's financial planning standards, right, and what goes into a financial plan, it's often, yes, the retirement planning, but also the investment planning, the risk management, which includes insurance, tax planning, estate planning, and a few other areas as well. But retirement is just one part of that. We have to look holistically at your entire financial plan to make sure that you are set up for success going forward. So there's a few different pillars that I want to talk about today, calling them the four core pillars. There's a lot of different pillars that we could probably add to this, right? A lot of different things that maybe I won't touch on as in detail today that we could separate as a separate pillar. But these are the four that I wanted to touch on today: cash flow and savings, your debt structure, risk management, and then investments. If we get these right and have these properly in place, then we'll have a solid foundation regardless of what emergencies, what things slap us in the face down the road. We'll be able to weather that fairly well. So the first one that I wanted to focus on is cash flow and savings. This is really what drives everything. If you're familiar with Dave Ramsey says a lot of good things. Some of the good things that he mentions is in regards to your cash flow and your income. One of his famous quotes is that your income is your biggest wealth generating tool, or your income is your biggest wealth generating machine. And I wholeheartedly agree with that. Our income is really what drives most of our wealth generation. Now, if you're of the 1%, or maybe you or a spouse owns a business, or you have a crystal ball and you're able to pick the penny stock, that's going to be the next Microsoft or Apple, right? You may be able to generate some wealth that way. But for most of us that aren't in that category, don't fall into that 1%, our income is really what's going to be driving most of our wealth generation. So we need to protect that, right? We need to protect our income and make sure that it's not just spent frivolously, right? And our budget is a big key and a big tool to make sure that we're protecting that income, right? Our budget determines how much is spent versus how much is kept. And so we need to make sure that we are aware, at least aware of what's going out compared to what's coming in. Too much spending means limited ability to save. I think that's obvious, but I want to reiterate that. Too much spending means a limited ability to save. More savings equates to less stress, more flexibility, and this is an important one, protects against forced decisions. And so if we have that cash flow, right, where we have more that we're saving versus spending, then that's going to open up more opportunities, allow us to have more flexibility. And I think we can all agree that the more we have that's discretionary, that's not being forced into debt payments or just general living expenses, that's going to reduce the overall stress that we see day in and day out. So keeping that cash flow available, and it doesn't all have to go towards savings, right? It doesn't all have to go towards long-term or short-term savings. We can put that as part of a travel budget or whatever. Just making sure that we have some that's not forced into, say, debt payments, so that if something was to happen, we can reallocate that to maybe more of a necessity. So the cash flow is the biggest pillar that we need to protect initially, because that is what drives everything else going forward. Next pillar that I'll mention is debt. And the debt structure particularly is how I want to phrase that, because we can use debt as a tool. Debt can be beneficial, it can be helpful, but we have to use caution and we have to keep that in check, right? We can use debt to increase our assets or future cash flow. That's when debt is beneficial, if it either increases our assets or protects or increases our future cash flow. Okay, I'll use student loans as an example. A student loan that can help you get a degree that can increase your ability to make money or potential to make more money in the future, that can be beneficial, because then you can use that to pay it off and still have a higher cash flow going forward. Another example that is the most common nowadays, our highest source of debt today in our society, is a mortgage, right? A mortgage to buy a house can be beneficial if done properly, because that will sit, right? That house sits on the balance sheet as an asset that will grow and appreciate over time. And that mortgage allows us to do so without having to put the full amount down. It also protects or increases our future cash flow. The main benefit of using a mortgage to buy a house is because it protects that future cash flow from increasing rents each year, right? And I'm not going to say we all have to go buy a house. There is a time where renting is the better option. Okay, I want to repeat that. There is a time when renting is the better option. So don't be afraid if you're renting right now. Don't be afraid to continue to rent until it's the right time. But there will come a point when purchasing a house may make sense to protect that future cash flow, because each year rents go up and you don't have nearly as much control over that as we might like. So purchasing a house with a mortgage can keep your housing expense somewhat stable, relatively speaking, each year. And then as your income goes up, your housing expense does not increase quite as much. Therefore, you have more accessible cash flow to allocate to some of your other priorities as you go. So those are a couple examples of how you can use debt to your advantage. And it's not like a credit card or other consumer debt where you're paying that interest, you're keeping that debt revolving, and it's not increasing assets and it's not protecting your future cash flow. In fact, in most cases, that type of consumer debt is detrimental to both of those areas. So if you're thinking about getting into debt for one reason or another, maybe keep that in mind. Does it help to increase my assets? Does it help to increase my future cash flow? And you can kind of use that as a guide if it's good debt as opposed to bad debt. A couple of things that are pretty obvious, right? Carrying high interest consumer debt, you want to be very careful about that. Try and get that paid down very quickly. Paying low interest debt faster. So if it's a mortgage, just say 2%. Yes, I have fairly recently talked to quite a few people that have a mortgage about 2%, and they're paying that down faster than they need to. It's not always a bad thing, right? Because there is an emotional or stress component to debt as well, but it's just something to keep in mind. Over leveraging is typically never a good idea. And then making decisions, especially decisions around debt based on emotions, is something we need to be really careful of. That can be, in the tune of keeping up with the Joneses, right? Your coworker buys a new car and that makes you want to buy a new car, right? Something that personally I'm going through right now. And it's okay to set those emotions aside and make more rational decisions. Next pillar that I wanted to go through is risk management. So risk management is one of those that often gets brushed over because it's not super exciting, right? It's not sexy. They're talking about risk management, right? Protecting our assets, but it is very important because we all have, like I mentioned, those emergencies that come up. They're unexpected as to when they're going to come up, but they are going to come up. So it's very important to be protecting what we're building. Right. And sometimes we call them the tail risks, right? Those tail risks that can derail your progress. I'm talking like a fire that burns down your house, or maybe an earthquake, right? That destroys some property. Those kinds of emergencies, you typically can't self-insure. Okay. So that's something where you can't, if my house burns down and it takes me $300,000 to rebuild that, I can't pull from my savings account to cover that. Right. So you need insurance to help cover that. That comes in the form of life insurance to protect your income, disability insurance as well to protect your income, umbrella coverage, which sits over your property and casualty insurance, and then estate planning as well. Making sure you have the proper estate plan in place, beneficiaries, living will, trust, power of attorney, all of that. We will have a couple more webinars this year around the risk management side, including estate planning. So definitely stay tuned. Stay tuned for that. This is, like I said, it protects against those catastrophic losses, right? If you're familiar with Charlie Munger, he was Warren Buffett's right-hand man. He said that he didn't want to pay for other people's fraud. So anything that he could insure himself, self-insure, he did. So for him, at least supposedly, I don't know if this was actually true, but I heard that he did not have homeowners insurance on his house because if he had a fire, house burned down, he had to fork over $500,000 to rebuild that. That was a drop in the bucket for someone who was worth probably a couple $1 billion. So for those things that are small that you can't afford to self-insure, you don't need that. This is for those catastrophic losses that you can't afford to pull out of your savings account to fund that. But also that brings into the account the emergency fund as well, which in that example that I mentioned at the beginning, if that gentleman had an emergency fund, then it would have protected those retirement assets from him having to pull from his retirement account. So, and as you see there, you can't save/invest your way out of the catastrophes. The last pillar that I want to speak to is investments. Now, this is a part of your retirement plans typically, but also other types of investments that can help grow. And as you see here, investments are the growth engine of your overall financial picture. Having your investments properly structured can create a good amount of wealth. Now, remember, your income and your free cash flow, that is your biggest wealth generating tool. Your investments supplement that. So your investments supplement that to help provide long-term growth and protect against inflation. Your investments, as much as we'd like to believe that they will create instant wealth or at least relatively soon wealth, they don't do that. It's long-term growth over time to help protect against inflation, to diversify, and overall reduce risk. Now, like I said, over a long period of time, 20, 30, 40 years, that can generate a significant amount of wealth, but it supplements our cash flow and makes that cash flow, that free cash flow that we're able to save, that much more efficient. So different types of investment accounts, obviously your retirement account, but I also encourage you, once you have that retirement account set up, it's rolling, forget about it. Maybe look to a brokerage or investment account for a little bit more flexibility for some of those shorter term goals. We're talking anything before, typically 59 and a half should be in a brokerage account. Anything that's set for after age 60 in a retirement account, because that's just more efficient. That provides that long-term growth, protects against inflation, and this is where we have the diversification, tax complexity being more tax efficient based on the type of accounts, pre-tax versus Roth, saving in a brokerage investment account that can be tax efficient based depending on your income bracket. And as you increase in wealth, that coordination gets more and more important between those accounts. So if you're at that point where you're kind of extending beyond the retirement accounts into some of those brokerage, real estate, alternative investments, reach out and we can help see and make sure you're being coordinated properly between all those different accounts. All right, had a couple questions on more specific to the debt structure around here that I want to refer to before I continue, because these are great questions. What do you mean over leveraging real estate? That's an important one and goes back also to the cash flow versus savings pillar. If you over leverage your real estate, so for example, let's say I buy a house using a mortgage, that is 50% or more of my take-home pay. That's what I would consider as over leverage, right? You're using too much debt relative to your free cash flow. And that is going to lock you into a long-term payment that restricts your ability to save outside of that. So over leveraging just means essentially too much debt. And then another one is about a HELOC to consolidate debts into one bucket. That can be a good option as well. For example, if you have high interest consumer debt or credit card debt, using a home equity line of credit to consolidate that to a lower rate can be beneficial at times. It's just important to make sure that you don't drag that out for too long. So using a HELOC or other type of home equity loan to consolidate those debts can certainly make sense. Just make sure you keep that in check and don't let it drag on for too long. When it comes to really all areas of our financial plan, financial decisions always influence one another. And we have to be aware of what the trade-offs are. Right? I'll talk more about the trade-offs on the next slide here, but I wanted to go through just a couple examples of how these financial decisions influence each other. Because a lot of times, and in this first example, we see it a lot, someone gets into a mortgage because they're, I got to buy a house, I got to get into a house as soon as I can. And so they overextend, they over leverage a little bit on that side, and they get themselves into a mortgage that's a little bit more expensive than maybe they should. That's going to influence how much you can save and invest, which I think that's pretty standard. I think that makes sense. Another example more on the risk management or insurance side, adding or switching to a high deductible health plan. A high deductible health plan, like it sounds, has a high deductible. You need to meet that deductible generally before the insurance kicks in to help pay those expenses. That means that influences how much you have to have in an emergency fund. The more deductible you have, the more you have to have in an emergency fund to help cover those unexpected medical expenses. And the third one here, debt/investing. The more you pay off that debt, the more you allocate to pay down those low interest rate debts, the less you're able to save and invest. And now I think it makes sense, but I just want to make sure that every action and every choice that we make regarding our finances influences other areas of our financial plan. And so we just need to be aware of that. That leads right into what I was talking about with trade-offs. I'll point out this the bottom bullet point there, that financial planning comes down to choosing, not optimizing everything all at once. And we can't, right? We can't max everything all at once. I can't max out my 401k plan. I can't go on an international trip with my family every year. I can't save for that second vacation home that I want to just yet. We can't do it all at once. So we have our priorities and we have to evaluate those priorities and make trade-offs as we go, right? We don't have enough income to fund all of these goals. I don't myself, sure you don't as well. So we have to be evaluating those priorities and attacking them based on where they sit in your priority list. So you can think of, and I would encourage you to list out what those priorities are for you. What are those financial goals, pre-retirement, post-retirement, and then put a number to them. Each year, my wife and I, we sit down and we write out on our whiteboard what our financial goals and priorities are, put a number to them, and then we start attacking those initial priorities a little bit harder or heavier than some of those that are lower priorities. So a couple examples that you see here in terms of those trade-offs: contributing to or maxing out your 401k account versus building an emergency fund. That's a great one that we see a lot. People continue to contribute to their 401k account because we need to save for retirement, save for retirement, save for retirement, and yet your emergency fund is not fully funded. As a reminder, that emergency fund protects your retirement savings. So that is almost just as important, if not more important, than some contributions to your 401k. So at times, I'll tell people to slow down or at least reduce your 401k contributions, build up that emergency fund, and then restart those right away as soon as you can. That is a very important priority. Another one is paying down your mortgage versus investing. A client that I work with, she was very concerned about her mortgage, and it caused a lot of stress. In this example, she had a mortgage of 2 point something%. She refinanced in 2021 to a 15-year. It was less than 3%. We showed her the numbers, right? Financially, it does not make sense to pay down that mortgage. But for her, it caused her a lot of stress. She wasn't fully able to enjoy her retirement. And so it didn't matter that she was earning a better return in her investments. She took 200 grand, paid off that mortgage, and now she's much more stress-free and able to enjoy her retirement the way she wants to. So that is an example of doing something that's maybe makes a little bit less financial sense and more emotional sense. Saving for kids' college goals versus saving for retirement. That's a big one. We run into that a lot. Better lifestyle today versus long-term flexibility. That's one that I get to with people who have maybe oversaved a little bit for retirement early in their career, which is a great problem to have. And they can sometimes scale back their retirement savings to actually enjoy their lifestyle today. So they're not just save for retirement. There's a lot of different priorities that we have. We have to evaluate those and evaluate the trade-offs and how it's impacting us long-term. And it's okay to put some things on the back burner while we address those that are a bit higher priority today. Coordination is key, and as your finances grow, as you start to extend into higher and higher net worth and wealth, which everyone on here is fully capable of doing, that coordination just becomes more important. So as you're building out that foundation, you want to take some things into consideration. Initially, you don't need 10 different accounts, right? We don't need 100 different accounts in there to grow your wealth initially. All we really need is a checking savings account, a retirement account, and then a budget debt pay down strategy, if that applies to you, to get that wealth started. And then as you get that solid foundation, you have those 4 pillars in check, then as your wealth grows, you can start to consider some other areas, additional accounts to fund different goals, whether that's investment, retirement, or just different savings accounts, evaluating the tax structure to make sure things are more tax efficient, and then looking to some alternative investments as well. As always, more complexity means more coordination. So if anything on the right applies to you, let's reach out and make sure everything is being coordinated properly between those different accounts to be most efficient. For the last few minutes, I wanted to spend a little bit of time on a case study here to evaluate an example that I ran into with a gentleman. We'll say his name is John in this example. And there were a few different examples I was contemplating going through today. One of them involved a couple making $600,000-700,000 a year and showing all the complexity and coordination there. But I figured that didn't apply to most people. So I wanted to make this a little more applicable to the average person, myself included. And so this individual, called John, single, 38 years old, income of $85,000 a year. Within his investments, he had done a great job saving, but only to his 401k. So he'd just been dumping everything into his 401k, had about $110,000 in there, nothing anywhere else. You see savings account, $6,000 between checking and savings, not much more than a month's worth of expenses in his case. A little bit of debt, car loan, credit cards that were revolving. He was renting. In terms of the risk management side, he had the employer health insurance, which was great, but he had no disability insurance or renter's insurance. His mindset was, I'm contributing a lot to my 401k, so I'm doing pretty good, right? And we said, Yeah, sure. You're doing good. But doing good, doing okay is often the silent killer of doing great and putting you into that next tier of wealth generation. And so we evaluated where his friction points were. Only about 1 month of expenses and savings, had that high interest rate credit card debt while investing as well. No backup plan if income stopped. That's an important one as well. And I'll reference that to the disability income that we talked about previously. An individual under age 65 is actually more likely to become disabled than to pass away. And I think that's interesting because most of us know the importance of having life insurance on ourselves if we have family or someone dependent on our income, but then we don't look and see if the disability insurance that we do or don't have is adequate when that's typically a higher percentage chance. So there's no backup plan there. Savings were all locked into the retirement account, which provided less flexibility. So when meeting with John, we changed a couple things. We temporarily reduced the 401k, which I know, shocker, telling someone to save less for their retirement. We reduced that from 12% to 6%. He was still taking advantage of the match, which if you get access to an employer match, 50%, 100% return on your investment, that's typically better than a 25% credit card interest rate, right? So sometimes it still makes sense to take advantage of that match if you have access to one. And we reduced those contributions, redirected that initially to build an emergency fund, while also creating an aggressive payoff plan for that credit card debt to pay that off within 6 months, right? Having an aggressive plan is very important and making sure you stick to that. Kept the car loan in this case as scheduled, right? It was a reasonable rate. It wasn't a 100+ year term, which seems like it's easier and easier just to get longer car loans nowadays. We want to keep those short and reasonable. On the risk management side, renters insurance, most cases require you to have renters insurance nowadays. Want to make sure you're properly protected from property and casualty standpoint. Added that disability coverage, at least long term. If you have an emergency fund to cover that short-term disability, where they have those initial periods before you can start collecting those benefits, you at least need that long-term disability to protect you in that catastrophic case. The investments, after the credit card was paid off, after the emergency fund was funded, then we started adding more back into the investments, a little bit more to the 401k, but then we also established a brokerage or investment account, began contributing that difference to the investment account for added flexibility. Now, those are some of those goals that he was wanting before retirement age. So before age 60, he could access that without any penalties. That's something like down payment on a house, or in this case, he didn't have kids, but if he had kids, maybe education funding, different types of goals that may need to be accessed before retirement age. So the outcome for John, after 12 to 18 months, he had $15,000 saved in his emergency fund. Credit card debt was completely eliminated. His only debt left was the car. We had a clear payoff timeline for that. Optimized his retirement contributions. Notice we didn't maximize the retirement contributions. We optimized those based on his goals, and that resulted in lower financial stress overall, right? And key takeaway here, really in general, is not to do everything all at once. It's to do the right thing in the right order, making sure you are making those steps to make sure you're on track for your goals, whatever they may be. That may be early retirement, that may be a normal retirement, and all those different goals along the way. So I wanted to introduce a tool. Some of you may have seen this, but this is something that hopefully you'll be able to take some of these principles that we talked about today, apply it into your financial situation, and provide those actionable steps to help you make progress month over month, year over year. This is Saveology. Like I said, if you've been in one of our retirement plans, you may have seen this before. But Saveology is a personalized financial wellness tool, right? Something that we're able to offer. We pay for it, so it's free access to this. It's just a resource to help you create that solid foundation for your financial plan. And so what it does is you can create a free account. You can scan that there, completely confidential. We don't share this with any one of your employers or any outside party, right? It's also not meant to sell you on anything. You'll see it does recommend you should have a little more term life insurance, or you need to have this, this, and this in your estate planning documents, or you should be saving this for retirement. But it never encourages you or points you to any one product or service. So it's completely confidential. What you'll do is you'll create a free account. You go through a quick quiz. It'll tell you if you're on track what areas of your financial plan you should improve upon. And then if you want to, there's also a section in there where you can schedule a meeting with us, one of our advisors, to review your situation, review your plan, and make sure you're on track. What I really like about this is it helps you to prioritize what's most important. So it'll say, if you don't have an emergency fund, that's option one, that's number one priority, focus on that, and then make progress towards those other goals as you go. So again, just wanted to make sure we left you with something actionable that you can use to implement to improve your financial situation, financial wellness. You just want to sign in, see what you're doing, see if you're on track, and then forget about it. Great, more power to you. So that's an option available to you. Again, it's called Saveology. You'll see GBS Retire on there because we're the ones sponsoring that, giving you access to that tool. So I saw a couple questions come in. I'll get to those, but just wanted to remind you about the upcoming webinars and how to reach out to us with questions. You see our general email and phone number there. If you schedule that top right QR code, you can schedule a meeting with us to review your financial situation, make sure you have those pillars in place, and answer any more specific questions that you have. And that bottom QR code is a way to register for some of these upcoming webinars and see the full calendar for the year, which we have some good topics coming up. So feel free to put any questions in the Q&A. I did see a couple of them come through, so I'll just jump right into those. All right. So question one, would a certificate, I'm assuming a certificate of deposit, be a good option instead of a savings account? And I would say yes and no. So a CD, which is a certificate of deposit with a bank, typically offers a slightly better return than a traditional high yield savings account or money market account. That's because they lock that money up for that period of time. Right, whether that's 3 months, 6 months, 12 months, varying periods. Certificate of deposit can be a good option for a savings account, but the only downside is that term. Right, so if it's locked away for 6 months and you need it, let's say, a tree falls on your house and you have to repair your roof, $30,000 gone. You need to have access to that savings account, maybe a little bit more liquid than a CD. So I personally don't have my emergency fund in a CD. I have it in a high yield savings account that's more liquid, easily accessible if I need it to be tomorrow. Right now, if it's for longer term money, if you know you're not going to need that for 12 months, then yes, a certificate of deposit can be a really good option. All right. Question, I'm 29, husband is 30. We've been contributing to a Roth IRA for 5 years. However, we are currently using a brokerage to manage our account that usually manages larger accounts closer to retirement. Should we move away from a brokerage to manage our Roth IRA ourselves? That's a great question, and it largely depends on how they're managing that. Right? I would say feel free to reach out. You can send me a statement of that and we can give you a second opinion to see if it's beneficial for you. But if you're young and have a long time until retirement, then I would say you definitely want to be aggressive, especially in a Roth IRA. It may make sense at least to tell them to be more aggressive or move it to an account you can manage yourself and stick it in more just aggressive index ETF options that can be just long-term buy and hold and give you potentially better growth. So feel free to reach out. We can help you evaluate the investments that are using there, as well as the cost you may be paying for that account. Sometimes the cost you're paying relative to the service or the value that you're getting doesn't quite line up in those types of arrangements, but we can certainly take a look at that and make sure. All right, so on Saveology, is it web-based only as there is the mobile app? Currently, it's web-based, so it's mobile friendly, but you do just go through it through the web-based site, and at some point they are developing the application side to it as well. So we like Saveology because they're constantly improving, constantly developing, and it is a local. We're here in Utah, so it is a local service, a local tool. And I'll just jump back to that while we're going through some of these questions as well. Is there a fee for a financial consultation? Great question. No, there's never any fee for these financial consultations. Our main goal and priority is to be an educational resource for you, right? We obviously have our individual private wealth management arm of the business that in a rare case, and it makes sense to continue working on there. We could talk about that, but these initial conversations are always free. And our main goal is to provide that education, not to sell you on something. Another question about scheduling a one-on-one with an advisor. That's that top right QR code there, or you can just send an email and we can coordinate a mutually convenient time to meet together. We try and be very accessible around those individual consultations. All right, one more question that I see in here. Yes, one other question about meeting in person versus Zoom. If you're local to Utah, our office is in South Salt Lake. So I'm more than happy to meet in person if you want to come to our office instead of Zoom. And if that's the case, just reach out, send us an email, give us a call, and we can coordinate that separately. So one question about disability income that I did want to mention, because it is a fantastic question. What type of disability insurance or how much is beneficial? And disability insurance, again, is one that you want to make sure you may have it covered through your employer, but it may not be adequate. So make sure you confirm what type of disability insurance you have and if it's adequate. Typically, you want the disability insurance that will insure you if you are disabled to the point where you cannot conduct the same type of occupation that you have. It's called your own occupation. Oftentimes, disability policies will insure you only if you can't perform any occupation. So you want to make sure if you get disabled to the point where you can't continue your occupation, then it will pay out. And typically, at least 60% replacement of your income is recommended. And so that's kind of a good guideline to get started on the disability side. All right, fantastic questions. Any others? Let's see if I missed any. Don't think so. Awesome. If there are any other questions that you didn't feel comfortable asking in the group, send us an email, give us a call, schedule a meeting with us. We're happy to be a resource for you. And then, like I said, keep an eye out for our webinars coming up. Awesome. Have a good rest of your day.